Hello, this is Professor Engelhardt, and we are continuing now with our series on the principles of macroeconomics. Let's hop into talking about monetary policy and banking regulations. Right, so a quick overview of what we're going to talk about. We'll look some at central banking and the role of the Federal Reserve and its structure. Then we'll look some at bank regulation, and finally look some at monetary policy and its effects. First, in terms of central banking, the main responsibilities of a central bank are fourfold. That is, first, to conduct monetary policy. Secondly, to promote the stability of the financial system. Third, to provide banking services for banks and for governments. And then finally, just various miscellaneous regulations. So for example, in the United States, some anti-discrimination regulation is administered through the central banks. Now, there are lots of central banks around the world. In the United States, we're probably most familiar with our own, which is the Federal Reserve. If you go to the United Kingdom, they have the Bank of England. Japan is the Bank of Japan. The Eurozone has the European Central Bank. So there are lots of examples around the world. So first, in dealing with the Federal Reserve, I want to deal with two opposite myths about the Fed. The first is the Federal Reserve is as Federal Express. Right, so when this is said, it normally is talking about the fact that the Federal Reserve is an independent body from the government. For example, it is not owned by the government. But a second opposite myth is the Federal Reserve is basically just the fourth branch of government, right? So we have the executive, we have the judiciary, we have the legislative, and we have the monetary branch. It turns out neither of these is really true. The truth is somewhere in between these myths. So let's take a look. So first, we have this term federal in the Federal Reserve System. So what is federal about it? So often, because of the way that the United States is structured, we forget that federal does not mean national. Federal does not mean government. Federal is a way of structuring an organization. That is, where you have both centralized components and decentralized components. So you are operating as a federation, is the idea. Right? So each of these components has some level of independence, but they're not totally independent because they are in fact bound together. And in that sense, the Federal Reserve is very federal. It has centralized components and it has decentralized components. So in terms of the decentralized components, there are 12 regional Federal Reserve banks. One example would be there's the Federal Reserve Bank of Cleveland, which in terms of the region, it covers Ohio, western Pennsylvania, and eastern Kentucky. When you look at these 12 regional Federal Reserve banks, you can look at a map of them. I'm not going to show one here, but they're divided up in a way that provided them with equal populations back in 1910. Naturally, these are not equal populations now. For example, a good chunk of the western United States is all under one Federal Reserve Bank, despite the fact that California by itself should probably have its own Federal Reserve Bank. Actually, even when I split California up, for that matter. Right, so I think that what happened was that we realized afterwards that we actually aren't that concerned about each of these regions being equal population. But then you have the central body, right, which is the Board of Governors. The Board of Governors is composed of 7 people. They're selected by the president, they're confirmed by the Senate, so they go through the same type of process, more or less, as you find for judges. Right? Then, when they get appointed to the Board of Governors, they serve a 14-year term, and it's not renewable, and so once your 14 years are up, you're done. Now, there is something of a loophole is not quite the right word for it, but a way around the 14-year limit, and that is that if you only serve a partial term to complete someone else's term, then you can't have your own full term. Right, so there is technically the possibility of serving for about 28 years if, say, someone takes office and then resigns immediately, then we have a vacancy, then you fill that vacancy very quickly, you can finish out their term and then have your own term on top of it. I will say that it's really, really rare to see people serve really long times on the Board of Governors. Now, the Board of Governors has a chair. The chair is selected again by the president, confirmed by the Senate, and it's a chair term of 4 years. So you're already on the Board of Governors and you are selected to lead that board for a period of 4 years. Now, this is specifically designed to overlap presidential terms. So while we know that for example, there's a presidential election in 2024, the term for the chair of the Federal Reserve is up in 2026, right? So it's 2 years offset. So you're going to have 2 years under the president that appointed you, and then 2 years under the following president. There's also a body within the Federal Reserve called the Federal Open Market Committee. It combines elements of both the regional Federal Reserve banks and the Board of Governors. It's really the Federal Open Market Committee that is the main policy-making body inside the Federal Reserve. It's composed of the Board of Governors, so those 7 members, the president of the New York Federal Reserve Bank, because the New York Fed is the one that actually carries out the policy in practice, and then 4 more presidents from Federal Reserve banks that serve on a rotating basis. Now, in terms of this question of federal as Federal Express versus fourth branch of government, we describe the Federal Reserve as being a quasi-public system. That is, it is half public, so it has public elements and also private elements. So first, the private components, it is owned by the member banks, right? So the government does not, in fact, own the Federal Reserve. These member banks, they, in effect, own shares, like shares of stock, in the Federal Reserve System. And for those shares, they receive a fixed dividend every year. It is also true that the Federal Reserve, the member banks in that system, name 6 out of the 9 directors at the regional level. So every region has 9 directors. 3 of those are from banking, 3 are leaders from industry or labor, and then 3 are considered the public directors. So those first 2 groups, a total of 6 out of the 9 directors, are appointed by the member banks. Now, the public components. Any earnings that the Federal Reserve gets outside of the fixed dividend that it has to pay to its member banks goes to the U.S. Treasury. So in 2024, that was $79 billion that were paid to the U.S. Treasury from the Federal Reserve System. It's also true the Board of Governors, as previously mentioned, is politically appointed. It's the president that makes that decision with the Senate confirmation. It's also true that the Board of Governors names the other 3 directors, those that are the public interest directors, at the regional level. So you can see, even at the regional level, there's a mix of private and public, and certainly at the more central level, there's still a mix of public and private as well. Now, one of the things the Federal Reserve does is it provides services to banks. Right, so this is mostly in 3 forms. So one, it accepts deposits of reserves. So banks typically do not hold reserves themselves. They instead deposit them with the Federal Reserve. Secondly, they make loans to the member banks through what we call the discount window. So if the bank is in need of funds, they can come to the Federal Reserve and take out a loan. And the last thing that they would provide would be check processing or clearing between banks. So this is through the automatic clearinghouse system, or ACH system. Sometimes you'll see that as a way that you can pay for things using your checking account. That's exactly what this system is. And this ACH system is jointly operated with the Federal Reserve and also the member banks. Now, bank regulation. So there's a lot of different bodies that are involved with bank regulation. The Federal Reserve is one of those, but there are also others. But just generally speaking in very broad strokes here, if you want to go into more detail, there definitely are courses about money and banking where you can get into more detail. We're just going to give an idea here for the principles level. So when it comes to bank regulation, the big thing the Fed does is supervision of what we call bank holding companies. So bank holding companies are larger companies that technically own multiple banks. A lot of national banks would be structured this way, where you have, say, several banks that may be chartered at the state level, but then have a national holding company that's over all of those. That would be something that would fall under the Fed's purview. The big goal of supervision is to ensure good risk management inside of the banks, so they have a positive net worth, so they're able to pay their depositors. Another thing that supervisors can do is you can force changes in the operation, or you can even force the sale of banks from these bank holding companies if you believe they're causing problems. Another thing that is done by banking regulators like the Fed would be stress testing for banks. The idea of the stress test is that we look at the bank's assets and say, well, what would happen if this scenario occurred? And they try to think about a scenario that has about a 5% likelihood of happening, right? So it's not super likely, but at the same time, not infeasible this is going to show up. So we want to make sure that banks can actually survive, right, these types of 1 in 20 events. Another point about bank regulation, right, is the role that deposit insurance plays. Right, so deposit insurance is really designed to protect banks against bank runs. Because one of the big concerns that banks have in our fractional reserve system is that if a bunch of us come and want our money out of the bank at the same time, the money's not there. Like, they literally do not have the money in the vault, right? So it's very important to banks that we not do this. Well, one of the reasons that people would engage in a bank run is that if a bank goes bankrupt, there was concern that depositors would not get paid. So that's what deposit insurance does for us as depositors, is it ensures that, say in the US's case, I believe right now it's a $250,000, at least at the time of recording, a limit. In the case the bank goes bankrupt, $250,000 in your account is going to be protected and paid back to you through deposit insurance that is administered by the Federal Deposit Insurance Corporation in most cases. And so in that case, I know that if I'm kind of worried about the bank that I bank at, and I think they might go bankrupt, I don't have to go rush out to the bank, pull all of my money out, because it's insured. Right? So that helps protect the bank from bank runs, helps protect the depositors from the danger that may happen if the bank goes bankrupt. Now, like any insurance, banks do have to pay for deposit insurance. They pay a premium. The premium they pay is based on the size of the bank and on the general risk level. Generally speaking, smaller banks are going to pay higher premiums, simply because being small does make you a little bit higher risk. And then also, if you have lots of risky investments, you're going to pay higher premiums as well. Another role we'll often point to for the central bank is that they're the lender of last resort. In many ways, this is historically the reason that central banks were created in many cases. That is, we realized there was a concern about bank runs, right? And bank runs have the potential to turn liquidity problems into solvency problems. So if we can only come up with some way so that liquidity problems don't turn into solvency problems. And this is really the role of discount window lending, right? So if we have somebody that's ready to back up and lend money to those banks that just need cash, right? They're perfectly solvent as long as people pay back their mortgages, auto loans, or whatever. They just don't have the cash right now. In that case, the Federal Reserve will step in and provide what we call a discount window loan. That is where they are directly borrowing from the Federal Reserve. This helps to ensure then that banks don't run out of reserves. Whenever they need more, they can just borrow from the Federal Reserve and then pay back later at a reasonable rate of interest. Central banks are also engaged in the execution of monetary policy. So the big goal of monetary policy from the central bank's perspective is to try to use the monetary policy to change interest rates in order to stabilize the macroeconomy. Right, so the big target that you see the Federal Reserve looking at nowadays is what we call the federal funds rate. The federal funds rate is the name given to the interest rate on overnight loans between banks. Okay, so it's an extremely short-term loan. So normally what this has been done for historically is that if banks are a little bit short of their required reserves, then they can borrow from another bank that has more than the required reserves. So it's really just borrowing reserves overnight, so you're hitting regulatory requirements. So that is typically the thing that in the Federal Reserve we talk about them lowering or raising interest rates. What they're really doing is lowering or raising a target for this particular interest rate. Now, the traditional tools that the central bank will use in order to execute monetary policy and carry it out is open market operations, which we'll talk about each of these in turn. Changing the reserve requirement, that's fairly rare, but is something that could technically be used. Changing the discount rate, so that'd be that rate of interest on discount window loans. And then there have been introduced, since the financial crisis in 2008, a couple of non-traditional tools. One we call quantitative easing, or the ample reserve policy. And then often tied with that would be interest on excess reserves. So let's go ahead and take a look at each of these in turn and how they work. And so the most common method historically for central banks to engage in economic policy, monetary policy, right, is to engage in open market operations. That is, that the central bank will hold government bonds, and they'll either go out and they'll buy government bonds or they will sell bonds in order to change interest rates. So let's talk a little bit about the mechanics of how that happens. So one option would be to do an open market purchase. So in this case, the central bank creates new money, uses it to buy bonds. Right? So it's new money that's being created to buy up the bonds. So you do that just on the open market like anybody else is buying bonds. The only real difference is that the Federal Reserve or the central bank in other countries would just be creating new money to do it, as opposed to using money they already have. Right? So we're creating new money, using it to buy those bonds. Because of this, there's now more money available to be lent. Because of this additional money that's available to be lent, interest rates will tend to fall. Now we know from things we've talked about in the course before, as interest rates fall, that's going to stimulate investment. GDP should increase as a result. So if you want to stimulate the economy, engage in open market purchases. On the other hand, we have the potential to decrease or dampen the economy, normally in response to high rates of inflation that we're worried about. So we have open market sales. An open market sale is just the flip side of an open market purchase. Right? So you hold bonds, you can sell them. Right? But as you sell them, that means that money is leaving the economy, going back to the Federal Reserve, and the Federal Reserve is not putting that money back into circulation. So on the whole, money supply is falling. As money supply falls, that means there's now less money available to be lent. As less money is available to be lent, interest rates rise. Increasing interest rates means that now it's not necessarily worthwhile to borrow to build that factory. Right? So investment gets dampened. As investment falls, so does GDP, along with that demand. The discount rate would be the rate of interest on direct loans to banks from the Federal Reserve. Now, I will say discount loans are fairly rare outside of times of financial crisis. Traditionally, these are what was used to meet bank runs. There's a bank run, so you come to the Fed will lend to you. And because of that, banks were often very cautious about taking out discount loans because it sends the signal that you're in danger of a bank run. Right, so that is something where this really wasn't used very much, except in times of crisis. So we saw enormous use of discount window lending right around the time of the financial crisis in 2007, 2008, enormous amounts of money being lent into existence through the discount window, but most of the time this is fairly rarely used. However, by adjusting the interest rate that you are charging banks on the discount through the discount window, you will then have an impact on on their own lending behavior, on the bank's lending behavior, that is. So now it is technically true banks can borrow even if they don't need to, and now we have seen a little bit of this through the process of what we call rediscounting. So rediscounting is actually a very traditional thing that the Federal Reserve did way back shortly after it was founded, but then it kind of fell out of favor for a while until relatively recently, so past after the financial crisis. So the idea of this rediscounting is that a bank will make a loan and then sell that loan in part or in whole to the Federal Reserve. So in effect, this is very much like taking out a discount loan, but just using that loan that you made as collateral, which is traditionally what was done back in like the 1920s when the Federal Reserve was fairly new. An additional tool that the Federal Reserve has that it can use to modify interest rates, the money supply, and the economy would be reserve requirements. So the Federal Reserve can change how much banks are required to hold in reserve. So if it increases the amount that banks are required to hold in reserve, now we'll see less lending, interest rates will tend to get driven up. On the other hand, it could also decrease this. Well, at the time of recording, they can't decrease it actually, because at the moment the Fed doesn't actually require the holding of reserves. The reserve requirement ratio is exactly 0, but that is something the Fed does have some discretion that they can change within some legal limits. I believe that it's somewhere between 0 and 20%, I believe, is where the Fed has discretion within that range. Right now they've chosen 0%, but they could increase it substantially if they thought it would help them meet their goals. So let's just summarize real quickly the traditional monetary policy tools. Right? So if you want to stimulate the economy, you want to decrease interest rates. How can you do that? Open market purchases. Open market purchases means now there's more money to be lent, lowers interest rates. Similarly, a lower reserve requirement would do this. If you lower the reserve requirement, now banks are allowed to lend more of the money that they have on hand. That means, again, more money available to lend, lower interest rates. And finally, the lower discount rate. If you have a low enough discount rate, it actually might make sense for banks to borrow from the Federal Reserve and then re-lend, right? So this would be a case where we definitely have additional funds available. Then, do we need to slow the economy? Do exactly the opposite. Do things to increase rates. Open market sales would do this by soaking up funds so they're no longer available. A higher discount rate would do this. If I can't borrow and then re-lend from the Fed, that's going to limit the amount of borrowing, increase interest rates, and then also a higher reserve requirement. Don't let banks lend out as much of their reserves, and that's also going to limit how much lending can happen, increasing interest rates. Now getting into more untraditional stuff. There's a policy called ample reserves, right, or quantitative easing. This came amidst that financial crisis, 2007 to 2009, in that time period. The idea of quantitative easing is that we already have interest rates at a really low level, right, but we want to make sure the banks feel stable. Right, so we're going to provide them with loads of reserve funds. So the big way that this was done during the financial crisis is that the Fed went out and bought a bunch of longer-term bonds and mortgage-backed securities, where typically that's not what the Fed does. Right? Typically, the Fed will buy very short-term bonds and the like. So this was really unusual in what they were doing. Now, the big hope from this is they would stabilize the banks by providing them with excess liquidity. That is, if there's a run on the bank, they don't need to worry about it. They have plenty of money in reserve because the Fed has provided them with so much money. Another thing that was hoped was that this would help to encourage lending. If banks have a whole bunch of excess liquidity and are allowed to lend it out, well, they may as well do so, right, so that then they can actually earn something from these funds. Well, that might have been the goal, although it's not entirely clear. Because at the same time as the Fed was doing this ample reserves policy, it started paying interest on excess reserves. Right? So now banks are no longer required to hold reserves. However, if they do hold reserves, then the Federal Reserve will pay interest, right, on those reserves. So this is a way of encouraging banks to hold some reserves even if they're not legally allowed, even if they're not legally required to do so. Now, there's another thing, you will occasionally hear this term, it's called a reverse repo. Right, so the idea of a reverse repo, it's actually really similar to interest on excess reserves. In this case, what happens is the Fed buys a set of securities from a bank and then resells to the bank the next day, but at a slightly higher price. Effectively, what they're doing is paying interest, right, on holding these particular securities. So when we think about the ample reserves policy, which has been pursued since the financial crisis, a big thing that it does is it decreases the importance of the federal funds market. All right, so the U.S. banks really are not lending to each other very much at this point. Where you actually see things happening in the federal funds market is a lot of, say, government-sponsored entities. That is something that we've seen happen. And these are entities that do not get to earn interest on excess reserves, right? Or, say, foreign banks, right? Similarly, they can't borrow, right, from the Fed directly, right? So the federal funds market has changed in terms of what it does, even if in principle it is still the same market where you can lend or be lent to for overnight loans between banks. So another thing that this ample reserves policy does is that it makes what we might call administered interest rates much more important. Right? So while it's true there's a lot of intervention in the federal funds market, fundamentally it's still supply and demand that are determining the interest rate. It's just that supply and demand are heavily manipulated by what the Federal Reserve is doing. However, when we look at what's happening now, where the federal funds market doesn't matter as much, the big interest rates that matter are the interest on excess reserves and the discount rate in particular, and to some degree the reverse repo rate. Right? So when we look at these things, these are interest rates that are directly determined, right, by the Federal Reserve. These are policy rates that are decided, right, which means these administered interest rates are way more important than they have been historically. So, now making the connection to the economy as a whole. We've already hinted at this, but just to be very clear, right, we can engage in two different types of policy. Now, there are lots of tools which we can use, which were just described, but fundamentally, we are either having an expansionary policy, we're trying to expand the money supply, lower interest rates, and increase aggregate demand. Or we have a contractionary policy. We're trying to decrease the money supply, which will increase interest rates and decrease aggregate demand. So those are really the two options that are available to us, though the details and how we carry this out, right, may change. Nonetheless, in terms of economic impact, we do expect expansionary policy is expansionary policy, contractionary is contractionary. There may be some little differences in the details, but it tends not to be hugely important. Now, there's an alternative view to how monetary policy works. Right, so one view is that monetary policy is all about interest rates, that is what I've been describing so far in this video. There is, however, another way that this might work, and this places the emphasis not on interest rates, but rather on the money supply. Right, so the idea here is that monetary policy has its direct effect on the monetary base, that is, the combination of reserves and currency available. Right, so say when we engage in open market purchase, what does that do? That puts new money into the economy, specifically new money into the monetary base. So this money shows up as reserves or shows up as currency in circulation. Right, then the money as a whole, right, the money supply, is going to be the money multiplier multiplied by the monetary base. So you can affect the money supply by affecting the monetary base, and that is in effect what is happening with the Federal Reserve policy. Similarly, the Federal Reserve policy can determine the money multiplier by changing the reserve requirements. Now, taking all this together, we can bring over the quantity equation. And so the quantity equation tells us that nominal GDP is equal to the money supply times the amount of velocity. So velocity is just the measure for how fast money moves through the economy. Technically speaking, it's how many times a single dollar gets spent in a year, or a quarter, depending on the time period you're looking at, right? But typically a year. And so what this means then is that monetary policy, that is the determination of the money supply, can control nominal GDP as long as the money multiplier is constant and as long as velocity is constant. If those two things are constant, then there's this direct connection between the money supply, and specifically the monetary base, right, and nominal GDP. But now we run into a couple issues with this view. One is the money multiplier over time has not been particularly constant. Now, there was a point in time, when you look at this time frame from about 1995 to about 2005, the money multiplier is extremely flat. But outside of that point in time, there's a lot of variation. We saw a huge drop in the money multiplier around the time of the financial crisis. That was a time when banks started holding a lot of excess reserves. When you hold excess reserves, it lowers the money multiplier. And since that point in time, we've seen a lot of variation in the money multiplier. And you can see that it has ranged from a low of about 3 in 2015, and then also going as high as about 5 just before COVID struck. Right? So there's a lot of variation in the money multiplier, which suggests that even if you have tight control over the monetary base, you're not going to have a lot of control over the money supply, and therefore very little control over nominal GDP either. Now here's the issue. Excess reserves, as I mentioned, really destabilize the money multiplier. Right, so historically, excess reserves were extremely small. Right? So you look at that time period from 1995 to 2005 or so, excess reserves were basically a flat line just barely above zero, right? Which meant that reserves that you had were all because they're required. And because people are only holding required reserves, that means that the required reserve ratio, or reserve requirement, is extremely important in determining how money works. But then the financial crisis happened, at which point we took the view we want people to have excess reserves. In fact, we're not even going to require holding on to reserves anymore. And this ends up really loosening the connection between the monetary base and the money supply, since now the money multiplier is not constant. I mentioned the velocity of money before. Remember, the velocity of money is how many times a dollar is spent in a year on average. Right, so take your nominal GDP, divide by the money supply, that gives you your velocity. Now, if you look at the quantity equation, it's really just a rephrasing of what I just said. Right? So money supply times velocity equals the price level times real GDP. Rearrange that, and you get velocity equals price level times real GDP, that's nominal GDP, divided by the money supply. So it's really just a restatement of this identity that exists. Now, one of the problems with the views that I mentioned before were, oh, if we only control the money supply, we can control nominal GDP. Well, that would be true if the money multiplier is constant. We've just learned it's not. And it would be true if velocity was constant. Well, here's what velocities looked like over time, up through from 1959 through about 1990 or so. Certainly velocity was not constant, but it's fairly flat if you look at the left half of this particular graph. However, then coming through the 1990s, we saw this huge increase in the velocity of money. It looked like people just stopped holding money for very long periods, so money was moving through the economy a bit faster. And then we started seeing it drop significantly, with it really tanking when we had financial crises and not really recovering. So we saw that happen when we had the financial crisis in 2007 to 2009, a huge drop in velocity, getting it back to where it had been right back before 1990. And then it continued to slip, right, in the ensuing recovery, until it happened again, right, in the COVID crisis. So when COVID happens, the velocity of money absolutely tanks, which makes sense. A lot of the economy is shut down, so we're not really spending a lot, right? So we see another big drop. Now we have recovered from that, but still, historically, we're looking at very low rates of velocity compared to what we saw, say, 30, 40 years ago. And so this does suggest a problem with saying, oh, if we can only control the money supply, then we can control nominal GDP. And it turns out it's not so, because velocity moves around. So the end result of all of this is when we look at reality, the money multiplier is not stable in a world where there are lots of excess reserves and where the amount of excess reserves varies a lot. The reality is also that velocity is not stable, which means, right, we don't really have the ability to, just by controlling the monetary base, to control the money supply and therefore the nominal GDP. So because of this instability, the Fed tends to focus on how it's impacting interest rates and how it's impacting lending levels. Right? So we don't see a whole lot of concern from the Federal Reserve on the money supply itself, because the way money hits the economy is going to depend on what velocity is, nor do you see a lot of concern about how the monetary base affects the broader money supply. Now, there are a number of challenges to monetary policy making. So here, first, just a few claims, then we'll look at these in a little bit more detail. So one claim is the Federal Reserve is anti-democratic. That is to say, right, the private components of it create an insulation between the Federal Reserve, who's making monetary policy, and the public, right, who certainly is going to be affected by monetary policy. A second challenge to monetary policy making, as it is in the United States, is that the Federal Reserve should perhaps be replaced, right, with some kind of monetary policy rule. So this is what we call the rules versus discretion debate. Is it better to have a set of people make this decision, or would it be better to have something on autopilot, just operating according to some fixed rule? And then finally, there's just the general question and disagreement about what the Fed should focus on. As it is, it's not immediately obvious that the things the Fed has been instructed to focus on are the things that it should be focusing on. Right, so first, the undemocratic claim. The reality is that the central bank, the Federal Reserve in particular, right, is at least somewhat independent, right, by its design. So for example, it is by design the Board of Governors, let's say, where there's a lot of influence from the President and the Senate on who's on that Board of Governors. They get to make that decision. But nonetheless, once you're on there, convention has been you stay there unless you have done something like really, really unethical or something like that. And we just haven't seen people get removed, much if at all, right, historically. Which then means that once you're on, one, as long as you're serving a full term, you can't be reappointed, so you don't much care about getting appointed again. You can't be. Right? And that's supposed to provide you with some level of independence. Right? Similarly, when you look at the regional banks, a lot of the influence there doesn't come from Washington. It comes from the regional banks in the given regions. So, again, this is not really something that is going to be under that much democratic discipline or political influence. So really the big question that some people ask is, well, does it really make sense, right, for a group with this much influence to be outside the bounds, right, of the political system? Now, another question that has been raised is, well, are they actually outside the bounds of the political system? Now, certainly in President Trump's second term, he has challenged this significantly, in that we have, say, trying to remove people, right, from the Board of Governors, something that historically really wasn't done. We also have, say, placing people on the Federal Reserve Board while they continue to work for the White House. This is something that, again, historically wasn't really done. But despite this, it's not really the Trump administration that first brings into question, right, whether the Federal Reserve actually is separated from the political system. There's been talk for many years about what we call a political business cycle. That is where we tend to see the economy does really, really well leading up to an election and then falls off after an election. And as far as the Federal Reserve has an influence, it might be being influenced by the political cycles. Another issue here is that 14 years is a really long time. As a result, very, very rarely do we actually see members of the Board of Governors serve their whole term. As a result of that, there are often vacancies which the president gets to fill. I actually went back and looked, this was a few years ago, at what proportion of the Board of Governors that is there at any particular point in time was appointed by the current president. And it turns out that number is typically more than half. Which that tells you something, right? That there are often lots of vacancies in the Board of Governors. They tend to hang around as vacancies for a while, which means then, right, when you step into office, you often have vacancies to fill on the Board of Governors. If you want a majority, you can get, if you can't get one immediately, you can get really, really close to one immediately a good chunk of the time. And certainly by the time you leave office, the odds of you having appointed half of the Board of Governors is actually quite high historically. So this suggests that this independence that is supposed to be there by design for the Federal Reserve is not actually there in practice. Another question, which I mentioned before, is this idea of rules versus discretion. Now, the argument here is fairly straightforward, and that is that if you have people making decisions, people sometimes make mistakes. Right? So discretion, right, allows for errors to happen. Now, it also allows for flexibility, for the ability to reconsider what is important, what is not important. However, when the possibility of having significant errors that have enormous macroeconomic consequences is there, certainly some people are going to call for replacing discretion with rules. And there are a number of rules that have been suggested. One of the classic ones was from Milton Friedman. Milton Friedman suggested a money growth rule that is just year after year, we're going to aim for about 5% growth in the M2 money supply. That's it. We're not going to worry about anything else. And so that would be one potential rule out there. Another more recent rule would be called the Taylor rule. It was suggested by John Taylor. John Taylor, it's an interest rate rule that he suggests, all based on what does unemployment look like and what does inflation look like. Wait, no, it wasn't unemployment. I'm sorry, it was the GDP gap. He looks directly at GDP. It has been modified to account for unemployment instead, though John Taylor himself is very clear that that is not what his rule is about. Right, so the idea here is if we know what the rate of inflation is, if we know what GDP looks like relative to its potential, plug these into a formula, it tells us what interest rates should be. Right? So the hope of monetary policy rules is that they'll limit mistakes. Right? They're going to improve predictability. Good predictability is good for investment, which is good for the economy in the middle to long run. Another thing that it does, though, is it limits flexibility. And that is really the big concern. And I think the reason that monetary policy rules have not been adopted is that there is this idea that we do want the flexibility to deal with situations as they arise. So certainly, not everyone agrees with that. And then finally, there's the question of, well, what should the Fed be doing? So by law in the United States, the Fed has what we call a dual mandate. That is, they are supposed to, 1, achieve price stability, and 2, achieve full employment. Now we know that these two are not necessarily totally compatible with each other, which means then, right, that they're going to have to operate in between and decide which of these is more important at any particular point in time. Now, a few questions get raised. One question is, well, why not just have a single mandate? There are many countries around the world who have adopted a single mandate. That is, it is the job of the central bank to target inflation and to keep that under control. Right? So that would be something that was actually very successful in New Zealand. New Zealand had fairly high rates of inflation. They reformed their monetary policy making and said, no, we're just going to have an inflation target. That's it. So Bank of New Zealand, administering this, brought the rate of inflation down significantly and did so without huge macroeconomic consequences. And a number of other countries have followed suit with this. Right, so this would be one possible reform. We might say, well, maybe it's not the Fed's job to ensure full employment. Instead, let's just have them focus on price stability. Technically, we could also go the other direction and say, well, maybe it's not their job to focus on price stability. Maybe what they should really be worried about is full employment. Legally, we can do this either direction. But then there are also others who suggest that the dual mandate is itself a good idea. These are both things we want the Fed to care about. We want them to care about price stability. We want them to care about the level of employment. But there are also other things we want them to care about. Things like, are we living in an asset bubble? Do we have a housing bubble going on? Do we have a stock market bubble going on? Are investors over-leveraged? These are questions that potentially might be connected with things like money and banking. So it might be sensible to have the central bank be involved with this and trying to prick asset bubbles. Another question would be one of inequality. There's a lot of concern about the fact that the monetary system we have may in fact fuel the level of inequality we have. If you look at the data, it does turn out that a lot of the inequality we see is not so much from like the 1% and the 99%. A lot of it's really finance versus everybody else. Like that is a huge gap that we see. So if this is the case, this does suggest there might be something about the financial system that creates this inequality. If that's the case, then it may fall under the Federal Reserve's purview to do something about inequality, at least to some degree. Right? So that is something where there is certainly debate about what should the Fed do, right? What should its mandate include? Are we asking it to do too much as it is? Are we asking it to do the right things or not? Is there more that we need to ask it to do and to balance with the other things that it is thinking about? That is still, and I suspect always will be, something of an open question.